Hello, YouTube. Today we're going to talk about whether or not there is more pain ahead because the relationship between the S&P 500 and the 50 DMA is flashing me some more signals. And the reason why is because when we look to the S&P, we're noticing a bullish pattern here, but we're not really seeing us bounce off this inverse head and shoulders neckline. Why is the reason, right? That's the big question. This head and shoulders is a shorter term pattern, but it seems to be the dominant one right now. Volume is flat after we got those Fed minutes, and we're going to circle back and talk about that in a moment. Looking here to QQQ, we note that we have an M and we have an indecision or a doji candle where we're now back above yesterday's low. S&P did not manage to do that, but this does not really look all that impressive after the worst day of the year. Here are the clues. DXY or the dollar actually got to its 50 DMA, digested it, and now is pushing off. That's a pop in a flag, and it looks like it wants more. When we look here to the VIX, same thing, inverse head and shoulders ish. It's kind of just a triple bottom. It led to hitting the 50, backing off, hitting it again, backing off, hitting it again, claiming it, losing it, claiming it, and then pushing off of it. So usually when we see the dollar up, we see VIX up. That usually leads to S&P going down and QQQ going down. So I think we have a great show for you today. Please stay tuned all the way till the end if you want to have all those great notes. Let's have a look here and see what was happening. Today, in my opinion, was the potential for a high volatility day. I think what happened is that we pulled forward yesterday's pain to today. So today is actually pretty muted. We closed right around 398.50, which we already talked about as being our Fibonacci level. So we're definitely playing math, at least the robots are. And there's an article I'll show you as to the reasons why I think that is happening. Remembering that tomorrow morning at 8:30, we're going to be getting a revision to GDP for Q4. We're also going to get initial jobless claims. I'll be paying attention to that. But the big one for me is going to be Friday, core PCE at 8:30. We talked about it on the weekend. I'm going to leave it there. This is what we also talked about. It is the weekly trend change. So stay tuned, and I'll give an update on the weekly charts. Let's actually just do it right now. So we look here to the weekly chart. We've crash landed on our downtrend, which is going to be the red line, and right on our apex. The apex for me means that it's where the crossroads meet or where we get a decision. We're either going to continue going higher and bounce, we're going to go sideways and break the uptrend, and then maybe we're going to start going back down. So that's very, very clear for me what is happening here. We talked about the boxes as well, which are usually going to be a reversal pattern, meeting those wicks. If we now look at QQQ, what's interesting here is that we actually stopped going up. So we stopped going up, and now we're starting to go down. So the S&P is being led by QQQ right now. The other reason why this is important is because we can see that we're still playing math here. 313.26 and 290.7. What are those? That's the Fibonacci retracement from our all-time high back down to our relative low going back to October. What do we do? Well, the high that we established so far this year is at 31368. Oh my goodness. That's like really close to 31326, Justin. Yes, it is. Why? Robots do the trading. So when robots do the trading, or roughly 8 out of 10 trades done by algos or high frequency traders, whatever, they pay attention to this stuff. It's like really important for them. And we look to where we're back down to now, 290.7. What's our low of the day? 292.50. Pretty close. So is this a cup with a handle, or is it just a nice classic breakdown? Let's look at a little bit more evidence to see what it's telling us here. So at least for right now, it looks like we're attempting a trend change, and there's evidence to support it. We look here to a note that I laid out to our group this morning, and thank you to everyone who actually joined overnight. I was pleasantly surprised that people actually want to learn and do well. So this morning, pre-market, I shared that on today, we already crash landed on the 50 weekly moving average. Strong weekly support at 395 and 398. If this doesn't act as strong support, that tells you more than the levels. This is the news versus the reaction to the news. And then down here a little bit later today, going into the close, I mentioned that ES and SPX have both tested their 50 DMA. S&P will be the last just because it's the ETF. It's not the index or the futures. It is not acting as strong support right now. That's a big warning for the bulls if we don't push off tomorrow. So what am I talking about? Let's go back to here. Let's go back to S&P. And I'll just note that even though we got to push off the 50, I didn't really find a lot of buyers there. When we look at the pattern, we have an inverse head and shoulders. We got our 50 DMA. We didn't quite test it. We're off by about 30 cents. But here's what's so interesting to me is that they only bought it up into the final 15-minute candle, right? Only into the close, only when they had to. And when do they normally do this? Well, they do it when they have to, not because they want to. So when we go from a low of 397 up to a high close of about 398.50, they're like the bears are just like, man, you guys want to punch it higher? Great, give me another rip to short, baby. Whoop. That's the way I look at it. They only bid up the close because they had to. It's not because they wanted to. So that's really, really interesting to me. That's what it comes down to. So if strong support is not acting as strong support, that tells you more than the levels themselves. So if you want to make sure you get all these notes every single day, just again consider subscribing to our 14-day free trial where you can trade from me, Justin from YouTube. And if not, I would just really appreciate if you could smash that thumbs up and just consider subscribing to the channel. I don't want to push you to do something you don't want to, but I think we're providing great value, and I would love to have you in our YouTube community. All right, here's what happened today with the Fed minutes. Fed inclined towards more Fed hikes, curb inflation, minutes show. Almost all officials backed half a point increase. Okay, what does CNBC tell us? Fed minutes reaffirm tough stance on inflation. Live updates. Okay, so a little bit contradictory there. Here's what actually happened. Pause the video if you want to read it. I'm focused on this part right here. Participants saw upside risks for inflation, including China's economic reopening and Ukraine. Cool. Participants said risks to economic outlook weighed to downside. So it's not really deterring them. Here's what I alluded to before too. ETF traders ditch risk assets en masse, pile billions into bonds. Major credit ETF junk and LQD both saw outflows of 1 billion. More than 2 billion was added to short-term treasury products. What does that mean? Yesterday, when everyone was drilling to selling on the worst day in 2 months, traders hyper liquidated some of the world's ETFs and corporate bonds and headed for the safety of government debt as yields broke to anew, which is what we talked about yesterday. This is a really interesting headline here too. The terminal rate, according to by May by Bloomberg survey, is 5.25. However, we now see that the terminal rate on the Fed futures outlook is actually jacked up here to 5.35, which was James Bullard's numbers. So market participants are not, people who got surveyed are not quite as hawkish as the actual rate outlook right now. Still pricing in a small cut going into October of 2 basis points and then a micro cut going into January as well. Here's what's interesting. As we look to our platform, I'm looking at week to date for SPY, and we're looking at dark pool levels here. Why? Because I just want to see where we're concentrated, where the way that I like to think about dark pool prints is that it's not like one set of money is better than the other, but what we can understand is what the other team is thinking as we start going lower. Why? Well, because these are orders that happen off exchange. So for every seller, there's a buyer. For every buyer, there's a seller. We don't know if these are initiated as buys or as sells. It just tells you levels of interest. So after we went from 407, there was roughly 8% or 2.5 billion shares traded there, or the equivalent of about 8% of the total daily volume. There's a big hole between 407 and 399. After we lost 407, I'm like, man, screw it. Buy down here, 399, 398.50, 398.50. So if we stay below all these levels, or basically where we are right now, that huge math number at 390.50, I don't think we're going to go higher. This is now acting as resistance. There's going to be all this red long shares that are going to want to get their money back. So we got to get back above 407.2, at least for this week's momentum to shift back up to bullish, which is the reason why I think that we might be due for a 200 DMA test where we can come back down and now test our absolute uptrend. The absolute uptrend meaning that it's going off the absolute levels. And if we don't find buyers over here, that's like a red alert. The bears want to be very mindful of that, and so do the bulls. So if you've enjoyed today's video, thank you so much for watching. I look forward to seeing you on the next one. Thank you again.